Good evening, ladies and gentlemen. I'm Pelshia, moderator of Ramco Systems Q2 FY23 earnings conference call hosted by DAM Capital Advisors Limited. As a reminder, all participants will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and zero on your touch-tone telephone. Please note this conference is recorded. I would now like to hand over the floor to Mr. Anmol Garg from DAM Capital. Thank you, and over to you, sir.
Thank you, Pelsia. Good afternoon, everyone. On behalf of DAM Capital, we welcome you all to Q2 FY23 conference call of Ramco Systems. We have with us Mr. P.R. Venkatramarajah, Chairman of the company, Mr. Sandesh Bilagi, Chief Operating Officer, Mr. R. Ravikula Chandran, CFO, Ms. Gayatri, VP Finance, and Mr. Vijay Raghavan, Company Secretary. I'll now hand over the call to Mr. Venkatramarajah for his opening remarks. Thank you, and over to you, sir.
Good afternoon, everybody, and thank you all for joining this conference call. As you can already see in the results, this quarter two has been similar to previous quarter, quite a challenging quarter. You're seeing these results based on the fact that we had fallen bookings in the last two quarters of last year, and the first quarter of this year was slightly better. So because of the fallen booking, our revenue growth has been quite slow. Number one. Number two, the effect of COVID had us making sure that we had to improve our implementation, so we had to increase the number of people. So a number of people had increased, so costs have also gone up, and all those things are now taken into consideration, and things are coming under control. And I think we are looking at, but the important point here is our pipeline continues to remain very strong, and we are looking forward to our bookings growth in the coming quarters. I would now ask Sandesh to take you through the presentations, and then any questions you have, we will answer after the presentations.
Thank you, Mr. Chairman. Good afternoon, everyone. What I will do is quickly give you some flavor on the market and the order booking, and allude whatever Chairman has alluded. I think what we were the previous call also, we had indicated what kind of work we are doing in the current year. It is going to be a lot of area which we would have to clean up from the backlog for the delivery and other area which we are focusing. So in two parts I will cover, from the market and order booking and the investments what we have made in sales and marketing, and how we are expecting that to reflecting in coming quarters and next year. And second portion is some of the activities which we have undertaken and how they are impacting on our bottom line, as well as how it is going to improve our execution capability, and how we are dealing with that. On the first part, you would have seen from the results, our order booking for the quarter remained at 17.32 million as against 21.7 from the previous quarter. We were expecting some of the orders which have just moved to the next quarter, but however, we remain confident those things should materialize in the coming quarters. It is slightly behind our expected numbers what we were looking for the quarter, but that should pick up in the coming quarters. Cumulatively for the H1, that remains 39 million, which is exactly almost similar for the H1 of the last year. In the last year, in the second part of the year, our order booking had plummeted to around 25 million, which we expect much better pick up in the remaining part of the H2. That is basically from $39 million which we have completed in the H1 of this year. We are very confident that these numbers will be better in the coming two quarters, which is basically in the H2. In the order booking in the current quarter, out of 17 million odd we have closed, Asia has figuring in around 35% of the booking, which was one of the reasons our order booking was much lower in the previous quarter. With opening of the market, we are seeing uptake in order booking in Asia, which is highest in the last 4 quarters for Asia. This quarter has been highest, which used to be our turbo engine. It is opened, and I think further we would start seeing better numbers coming from this region. Other regions have stood or improved in the order booking positioning. We also invested during the COVID period, lot of investment we had held up in the sales and marketing, which beginning of this year, we increased our spending on marketing as well as the sales activities, which has resulted, and I think we are seeing good amount of pipeline build-up, and in fact, contracts which we are negotiating and the advanced level of discussions what we are having has increased to good amount, which is giving us that hope in the coming 2 quarters we should be able to do better. These activities we are seeing around across all business units and across all the geographies. We are around $600 million on the pipeline, which is more than half of that is in the good stages, what we call as the active and advanced stages. So that would hopefully result in better negotiation and closures as we move forward, and that is after a long time we are seeing good uptake in the pipeline build-up, and that should result in better order booking and revenues to translate into revenue in coming quarter. Part of the activity what we had undertaken, some of the areas of the project which we had to execute, I think backlog projects which we had identified, and we are relentlessly after to complete some of those projects which we are approaching. Some of them, end of this year, we should be coming out of some old execution areas. We should be able to conclude, and barring 2 projects, most of the other projects we would have completed our activities there, in that area. And also during the last year, we had, like everybody in the industry, our attrition rates were sitting at around 32% for the last year. To cater to addressing the customer situation, we would have to resort to high number of people as well as holding some inventory, which we did, and in fact that also increased our manpower from average 2,000 headcount to around 2,400, and that was utilized on the backlog project as well as having the team and rest, which we are now seeing with the attrition coming lower in this last 2 quarters. We are sitting at around 14%, and we expect annually it will probably taper it around 24%, which at the pre-COVID level it should go back. So that means I think the pressure on manpower and manpower cost would come down, and we expect that to translate into better cost management from the people perspective in coming quarters. And we also, during the last 2 quarters, aggressively we have gone to adoption of the DevOps on the CI/CD and test automation and RPA. We have made good amount of investment so that we can automate our engineering processes as well as the implementation area, so that we can increase our speed of implementation and go live. And I think that also should start showing results in coming quarters. That we are continuing to adopt across organization, in every product line which we are pushing and aggressively adopting those areas. That is from the operational side. We see there is going to be some efficiency which we will start seeing in the coming quarters. That is the overall on the update from business perspective, and we will open this for more questions and details on the fact sheet. Some more details on the recurring revenue and booking revenue, everything is in the fact sheet which we have published. We are open for questions here.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. If you have a question, please press star and 1 on your telephone keypad and wait for your turn to ask the question. If you would like to withdraw your request, you may do so by pressing star and 1 again. Ladies and gentlemen, if you have any question, please press star and 1 on your telephone keypad. We will wait for a moment while the question queue assembles. The first question comes from Vivek, Bestpals Research and Advisory. Please go ahead.
Sir, good evening, sir. Thanks for the opportunity. During around 2017, we started pivoting our company and this cloud, this HCM, and we have divided this into 3 different business units: aviation, HCM, and ERP. And we started also pivoting in terms of going into advanced markets. Where are we not? Because I'm only seeing the results, right? So I'm not seeing what is happening behind the scenes. So maybe it's coming from there. We are not able to. Are we not getting our go-to-market right? Are we facing a lot of competition and we are not able to? Our products not up to the mark? Is our competitive positioning weak? What are the challenges that are not allowing us to, maybe as investors, not able to see the results of order? Even now, order booking has come down, and still the reasoning is that it is because of the external environment. If it is because of the external environment, it is okay, but is it because of some other startups doing better than us and offering, and we losing our competitive positioning? And because that kind of a data is not provided, I'm asking this question. So the pivot that we did when Virendra Agarwal came and started seeing results by adding a lot of clients in HCM in US and all, we are not seeing the results of it maybe in financials. But if you can throw light on what are the challenges you are facing, whether it's go-to-market or product or competition, or you're not facing, and it is just that we are feeling as investors because we are not seeing. And if you can guide us on whether you are confident of scaling up this business, on if you're confident, which products do you think will help us scale? So I think this would help us, because we have been invested for the past 4 years, and this is the confusion we have because of not seeing in the numbers. So thank you, sir. Hello?
This we had addressed in the last few investor call. I think that I will again repeat. I think one of the major business area in the HRP, which basically, if you see, our competitive positioning is we are having 65 plus countries payroll we have built on our own, and majority of them in the Asia Pacific region, which had a severe impact for us from the go-to-market, because I think markets were shut, and I think that used to be very high amount of order booking we used to do from that region, and this region is akin to meeting people and not in a way digitally and remotely you won't be able to close the order, and we had unexpected down in our order booking. That, as I said initially in the opening, I just mentioned that is opening, and we are seeing Asia is coming back. That should start reflecting in our numbers in the order booking as well as the revenue. And in case of aviation, that is progressing. In fact, I think our what you won't see in the quality of revenue, quality of booking, what we have seen in the last quarter in the general atomic and multiple other area, we have branched out from majority in the heli segment and MRO, majorly into all other aspect of the MRO and as well as for the eVTOL and drone, those segments, whatever investment we have made, we have started seeing wins beyond our traditional area. The newer areas into aviation, we have started seeing. Probably that is also going to accelerate in coming quarters, where we also see good amount of traction, good amount of build-up there. It is matter of closure, which we are expecting that also should start working there. I think, next 2 quarters, you should start seeing in the defense and AAD, what we call as the aviation, Air Force and defense, that business also. And we also in the previous call, we mentioned in one or 2 areas of the segment in the core ERP, we were packaging and probably we are concentrating on going live on some of the customers which we have picked up, and which is the case still so to remain for another 2 quarters. And then we will start seeing that is a conscious call which we are taking that also will start reflecting post another 2 quarters. So you should be able to, I think we said this current year is the year of consolidating and probably delivering them, whatever we have booked the orders, and that is the same path we are in. So we did mention, and I am repeating that, I think that remains our position now also for the current year. It is going to be year where we would be focusing on execution and building up that execution capabilities. However, good thing is that pipeline, as I said, is across all business lines, across all geographies, strong pipeline we are witnessing, and there is a demand for our products has not gone down. I think it is a matter of time.
So you're confident of scaling even beyond 25 million order booking per quarter in the next year, in the sense in the next 2-3 years it will be much above the 20, because we have not crossed that.
Yes, that is exactly what I'm saying. I think that is what, and this year.
No, sir. Where I was coming from is, are we facing any challenge because we are not able to maybe not know the things that are happening behind the scenes. So any data that if you can provide on quarterly basis on in terms of competition, where things are going, so it will help us as investors better to evaluate. Hello.
Okay. Your request was to provide the competitive information, how we stand vis-a-vis in each of the product line, is it?
Yeah, what is the exact TAMs that you are addressing? What is the exact use cases? So a little bit detailed, maybe once in a year at least, a little bit more detailing, so that because we have been actually last 5 years, this is if you see it is in every con call we are confident, but things are maybe we are not able to understand. So I just thought if I can request you to provide more detail.
Okay, I think we will try to make it for an annual. I think from the whatever we can disclose on our customers, and that to some extent we have also given I think average order size and other things we started publishing. That also will give indication to say that earlier it used to be our order size sub $500,000, which moved to $1 million to 750K to $1 million and plus order book. So that will also showcase the kind of customers we are closing. Probably we can also classify on the foreign size and multiple other areas to give the quality of revenue which we are booking. Point noted.
And also about the So more So thank you, sir. Thank you. All the best, sir.
Thank you. The next question comes from Pavnish Kumar from Ridya Skar. Please go ahead.
Hello, sir. Good afternoon. Yeah, my question was also on the same lines as was asked by the first speaker. Like in every con call, we talk about like the pipeline, the order book, but somehow we are not able to convert it in the revenue. We have added some staff also, maybe some manpower also. I can see in the balance sheet that we increased the expense on manpower. but still, I don't know why we are not able to convert our healthy pipeline into revenues. We have such a good brand name in the market, but still, this is not. I mean, this kind of performance is not justified for the brand also. I'm sorry for using a bit aggressive words, but this is what I feel being invested in Ramco Systems for past 2 years.
Yeah, I mean, we have acknowledged that has been in the challenging year for us. And also, another thing in the last quarter, I went in detail in explaining this structural change in the way the deferred revenue recognition model what we were having from there to, where we are only booking the recurring revenue. That is the change which I clearly explained it in the last, me and our CFO had explained that. I think that is also having the impact of revenue not being exactly commensurating with the number of booking what we are making. But that would eventually iron out in next 2 quarters, that you will start seeing revenues catching up with the equivalent of order booking what we are. And obviously from execution capabilities also the enhancements what we are making, that would also see that our implementation timelines will come down, and that would mean our order to cash time also will start shrinking. We should start seeing that reflected in the revenues.
What exactly is our order book and what exactly is our pipeline, sir, as of now?
Order booking is an unexecuted order booking you are seeing in the 181 million cumulatively. That is what it is, that is the roughly 5-year TCVs, what we consider in the unexecuted order book,
This is the confirmed order book that you are telling me about.
Sorry?
Correct.
Is this the confirmed order book that you are telling me about?
Correct. Signed orders.
Okay, signed orders.
Unexecuted orders is the signed orders.
And what would be the pipeline, sir, which is exclusive of this order book?
That is, I said, that's in the range of around $580 million. That is what the total order book what we are chasing.
Okay, just one last question I would like to ask you, sir. I'm very convinced with your statement. Like this quarter, we have booked revenues of around 15-16 million US dollars. Right?
Yes.
For next 2 quarters, what would be your guidance? I mean, how much revenue can we book? In next 2 quarters, I'm asking about.
No, revenue guidance per se we normally don't give, but we have indicated the order booking will be better than this the previous 2 quarters.
Will we be able to close the quarters in black, sir? Because I think it's been 3, 4, 5 quarters continuously we are in red.
Closing the quarter in black is not going to be the immediate one.
Okay.
Here also, because going by this one only, it will be too much to expect even internally. So, see, we have said in the earlier call that our first target is to bring back the business to the normal, the pre-COVID time, and to have a healthy order book. Only then the year after that can be a better one.
Okay, got it. Thank you so much, sir. Thank you.
Thank you, sir. Ladies and gentlemen, if you have any question, please press star and 1 on your telephone keypad. I repeat, ladies and gentlemen, if you have any question, please press star and 1 on your telephone keypad. Next question comes from Rahul Jain from Dolat Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. I mean, looking at this performance of HRP business, I mean, it's very difficult to match the commentary with the performance. If you just look at the revenue, how it has fallen from what we used to do in FY19 and 20 versus what we have done in the last 2.5 years. And we have always while talked about how the opportunity has strengthened in terms of number of payroll, number of new market, number of clients, which has scaled up in terms of more market. what is not happening here? Because even from a mega event of we getting empaneled with bigger players like Workday and Oracle, that has also happened more than a year now. So why some of these things are not culminating? And also, even from an unexecuted order book, I don't understand the maths out here, because this number continues to be upwards of $100 million for ages now, but it's not getting into the revenue recognition. Or is there something like we are skipping a lot of existing revenue for which it is getting replaced, and that's why it does not translate into revenue? If you could explain these two things, that would be of great help. Thank you.
Unexecuted order. Yeah.
HRP.
In HRP, I think we also said this is the one business we have completely gone on per employee per month basis, which is a SaaS akin model, which earlier we used to have licenses being booked for that one, which we have completely moved away from that. This in the HRP business, almost everything currently what we are reflecting is the recurring, and it is a transaction-based prices we have moved per employee per month. So that is only the reason, because that is the market, as well as for that is how we wanted to operate in this market. And that is the reason, I think the revenue adjustment you would see from the previous periods in 2017 and 18, roughly more than 50% used to be the licenses, what we used to book, but that used to be long run, it would be not good for the company, because it will be perpetual licenses you will sell, and you will not be able to get that higher realization.
Sandeep, sorry to interrupt in between, but are we talking just for HCM business also? Because ever since this business has been separated into a separate SBU and the revenue data has been given, I think we have always talked about this business to be very cloud-centric. I don't know, where is this mismatch from earlier thought versus now?
No, I'm talking about the HRP only. I think it used to be also licenses in this business as well, which we, gradually we have moved to, PEPM, and currently it is almost everything what we are booking in last few quarters is been only on the PEPM. That's the gradual change which we have, made. So you made a reference to 2017, and I think that is the reason I just wanted to bring it to your attention. This is the one structural change which we have made there. That is for the HRP business alone. And however, it remains in the other businesses, the licenses amount are still in the ERP and aviation businesses. They still continue to have some on-premise businesses. That is from that one. And recurring revenue wise, we will have RKC commenting on the unbilled.
No, unexecuted. Rahul, to your question on the unexecuted, the max will work out. See, we had 178 million last quarter, and as unexecuted, we have booked 17 million this quarter, so that makes us 195. And we have a revenue, out of that only we have taken the revenue of 15 million. So closing order book is 180 million. See, what you see in the fact sheet is 181 million. So the number is matching.
No, I can understand RKC, the match between June to September. What I'm trying to understand, if any company has a order book of upwards of 120 million for last 5 years, how the average revenue can be sustainably at 80, because that order has to come into revenue at some point of time.
That is because, Rahul, the unexecuted book consists primarily of the services and the AMC. So an AMC cannot gallop. It has to be, you have to divide equally. Only the service component will make a difference, depend on our milestone achievement and the accrual of the revenue. In our case, because of a lower order booking and consequent now effect on the number, even accrual is at the same lower level.
Rahul, and also in unexecuted order book, when we book the order, typically it is either 3 years or 5 years contract what we sign, and whole amount is taken into unexecuted order book. So suppose if it is a 5-year if you book, that will be consumed over the 5-year period rather than in any 1 year. If it is signed for the 3 years, it will be consumed over the 3 years rather than immediately it is reflecting. So it is somewhere between 3 to 5 year worth of amount when we call unexecuted order book. Somewhere it is to be consumed over 3 to 5 years. That is how I would see unexecuted order book, and rather than directly correlating it with the revenue immediately to exhaust those.
Yeah, I understand that, but I mean, we are not talking about 1 year data. Even if you look at the data from the day this data has been started being shared with us, the number has been a much higher number. So in a way, the only mathematical conclusion to this is that our addition into the new orders is equivalent to our current revenue of 70-80 million every year, and that's why whatever we add is whatever it goes away, and the unexecuted order book never translates into revenue. Because ideally for any company, the more the unexecuted order book grows, we should, on a trailing basis, we should achieve what is the unexecuted order book is from a 3 to 4 year lag basis. But despite this number being consistently higher in the 150-180 zone, we have revenue that's still in that 70-80 band for a fairly long period of time. And also to your AMC or the recurring revenue kind of a comment, even from, if I just look at the AMC plus subscription kind of a revenue, this number has not grown for the last 2 years. So is it fair to assume that whatever new customers that we have added in this period is equivalent to number of people who might have left us as a matter of attrition, and that's why the revenue number has not moved even in the AMC subscription line item?
Rahul, your question on the first question on the unexecuted order book. See, by nature the composition is primarily the subscription or AMC plus the services. So that's why I was saying it cannot go up very exponentially higher unless we have a very higher order booking in one of the quarters. Because if we have something in the unexecuted order book towards license, that can make a difference, but that never happens because license, once we deliver, we accrue as consider as a revenue. So that is the reason it is even. Second, on your AMC question, which is more or less on a straight line, that is a fact because if you see our license revenue has not grown. In fact, 21-22 versus 2021, we have 10-11 million drop in the license. The customers have not left, but the inflow of licenses are low. So correspondingly, the AMC is also low. But when you see the existing AMC plus the new AMC, it's in a flat line. It is not on an upward curve.
No, so RKC, if we just add the number of license for last 2.5-3 years, that still be a $40-45 million number, and then even assuming 15% of that, the AMC run rate should have gone up by 6 million, but that's not happened either.
I don't know what is 45 because if you see the license revenue, even the fact sheet, if you see against 18 million in 21, we have done only 7 million in the next year, 22. We had given separately the license revenue. So the license revenue is not increasing. See, what happens is with the license revenue doesn't increase, the AMC also will not increase. So we have to depend on the existing customers, and the good point is no major customers have left as problem.
Right. I mean, we can take this conversation offline, but I mean, I hope you're getting a message that somehow the metrics are not relating to the outcome, because metrics are far better compared to the P&L that we keep reporting. In terms of another comment which you have mentioned in your opening remarks was about some past project getting concluded and only 2 projects are left. What are the repercussions of those in terms of revenue or cost items? And in terms of general cost increase, what and looking at your talent requirement and attrition situation, what do you think is the likely run rate for cost increase going forward from current level?
Yeah, I think, roughly, I think the large project execution, some of close to 10 to 12% of our manpower was locked into that one. I think that I would say as some of the projects which are critical projects which we are executing. And I think that is the one reason. And second is because of the high attrition, we had to have higher inventory of resources. Moving forward, cost will not increase. I think your question was, will there be any increase? That won't be. In fact, the natural attrition and other areas, it should start dropping on the manpower also. The cost and other things which should be not increasing moving forward. We are not anticipating any upward increase. Whatever increase from the headcount as well as the salary increment and retention bonuses and whatever we had to do, all those extraordinary measures what we had taken, which we have done already, we don't expect to pump in or increase any cost further than this.
Right. And sorry to repeat, but I think one aspect remain unanswered was about this Oracle and Workday collaboration that we have done. What's the status on this? When we see that pipeline to actually flow into orders and revenue?
That is the with Workday and Oracle. In fact, I think that is we are seeing this quarter the order booking from HR was lower, definitely less than our expected one, but still the pipeline is in very healthy term. We should start seeing most of our order closures, whatever we are doing in HR, now it has linkages with either Oracle or Workday. Strongly we are embedded there in the ecosystem. I think all the, in future also whatever you start seeing, the order closures will be related to this. So that is moving forward. In fact, we also participated with both the premier events for the Oracle and Workday Rising and Oracle Open World, and we have seen good interest coming from implementation partners of Oracle and Workday, number one. Second, from the customers and people who have adopted HR of these companies looking forward for payroll, that we are still working through, and we expect that would continue to increase in the closures what we are seeing. That will have impact, good impact.
Thank you. That's it.
And Rahul, on your question on the license in 17-18, no, in the time frame between 15-16 to 19-20, we were an average of about 8.5 million from HRP licenses alone. That has now come down to 2.5 on an average for the year. Because of the annuity model. The impact you are asking, right? The impact per year itself is around 6 million, Rahul, for HRP alone.
Yeah, I do agree. Maybe we'll take it offline, but the number has to be cumulative. So there's no reason why it should not go up, even if the license run rate comes off every year. It is a accretive number. So the base should only go up every quarter by the logic of the revenue recognition.
Okay. Fine, we'll take it offline, Rahul. Yeah.
Thank you. Next question comes from Jyoti Singh from Aryan Capital Markets Limited. Please go ahead.
Thank you for the opportunity. Good evening, sir. So my question is on the geography side. So as we are contributing around 25% America and 6% Europe, so are we seeing any delay from the client side because of the macroeconomic concern? And another question is on the attrition side. So, what did you mention about the attrition? If you can explain it again. Thank you.
Yeah. I think on the geographic side, I think I mentioned that Asia I think in Q1 of last year, it was at least from there, I think it is a threefold what we have seen in the current quarter. I think that was one of the underperforming market for us that we are seeing good traction and moving. However, your question on the Europe and US, Europe, it is new market. I think we never had a very big one, but we are seeing good build up there, and decision making also we are not seeing any impact as of now. US, though it has slowed down, I think it is not a impact what we have seen, the big impact in US on the decision making and order booking, but some decision delay and slowdown and bit of a hard negotiation on the cash flow side, which we are seeing from US market right now. Whether it is a impact which we have identified, we are watching, but I think I would not call that as any material impact as of now we have identified on our order booking for the coming quarters. Number one. Second, on the attrition, your question was, I mentioned last year was 32% annualized, and current half year in the Q1 we were at 8%, and it has dropped to 6% in Q2, which is cumulatively around 14%, and we are seeing and we are expecting that would taper down further from current 6% what we are seeing. So overall for the year, below 25% is what we are expecting to see that number, and we looks like we are on tracking on lower number on the attrition.
Okay. And sir, my question is on the growth side. What kind of growth we are looking forward for FY23 and 24, and what kind of strategy we are following for the same?
Yeah, I mean, look, at this stage, I would say, I think we are, our first priority is to booking and other things to come back to the pre-COVID level, and that is what we are working. We have not given the guidelines from the revenue perspective, which we don't, but what I can say is, I think we are seeing from the next year onwards, it should normalize. I think the investments what we have made, I think which was completely dried down during the past 2 years, which we have increased our investment, that is showing green shoots all across, and we are very hopeful that we should bounce back to the first step is to bounce back to the pre-COVID level, and that is what will be what we are hoping, and probably better than what we were in next year.
Okay, thank you so much.
Thank you. That will be the last question for the day. Now I hand over the floor to management for closing comments.
We would like to thank everyone for being patient, and I think we have been transparently explaining on this call. This is in the current year what we are doing, and this year is going to be of area where we are focusing on the fundamentals and rebuilding some of the markets and some of the backlog area completion, and which will continue for the current year. And we would like to thank all investors for being patient with us, and see you next quarter on the call.
Thank you. Ladies and gentlemen, thank you, sir. Ladies and gentlemen, this concludes the conference for today. Thank you for your participation and for using Doorsabha's conference call service. You may disconnect your lines now. Thank you and have a pleasant evening.